what is the distinction in your strategy that has changed in the last week?
Really no distinction in change. We have taken off a fair amount of short exposure. A lot of the really high flyers, we think, the catalyst that we thought would bring them down has brought them down. We're not being greedy, and at this point in time, we're beginning to change our view on growth. I know a lot of people don't like growth. We haven't liked it in a long time, but our first step is to take off that short exposure on the high flyers. The other thing that we're looking at break-evens. Break-evens are now in that 250 to 275% range. That's pretty positive for growth, because what's happening is monetary policy and other issues are starting to slow down the economy, and growth does very well when growth slows down.
Let's put this into English, Chris. When do you start buying big tech?
Oh, gosh. I don't think you can. At the end of the day, I don't think you can just paint big tech with one paintbrush. There are companies that have good valuations and they're steady growers. And that's what you want to focus on, whether it's big tech, small tech, medium-sized tech. You want companies that are steady growers, that are trading at reasonable price, no matter where they are.
Chris, we're looking at a narrative that's shifted. As you mentioned, break-even rates have actually dipped to the lowest levels if you look at some of the longer-term ones going back to March, right? We're looking at basically people pricing in a slowdown. Have they gotten ahead of themselves based on the actual concrete data that has not reflected that?
Lisa, we came into this year saying there's going to be a slowdown, and that's what you're seeing. A lot of people are calling for recession. I think recession or recession talk is a little bit premature, too early. But we're in a slowdown, no doubt about it. This is the part of the cycle that we're in. And now when you start to normalize interest rates, you normalize monetary policy, that slowdown gets more aggressive. The other thing that we start to see is margins are being compressed because people can't raise price, or companies can't raise price as much as they want to, or as much as costs are going up. That creates a problem. That creates a lot of issues in and around the stock market. But overall, we're in a slowdown. We'll continue to be in a slowdown. But if you look at the underlying fundamentals, a lot of cash, and recession calls, I think, are very premature.
Chris, Harvey, talk about the equity market and how you synthesize Wells Fargo economics. So much of that was invented by John Sylvia of a number of years ago, and Sylvia was front and center on the job market. What are you hearing from Wells Fargo Research and Wells Fargo economics about a fully employed America, and then roll that into what it means for the stock market?
Yeah, Tom, that's a great question. And Tim Quinlan and I talk almost on a daily basis. I talk to a lot of the economics team, but Tim and I talk almost on a daily basis. So one of the things that he points out is if we're going to have a recession, it should manifest itself in the job picture, in unemployment, and the place to look is in claims, because that's the first place that you're going to start to see the stress. If claims start to go up, then you get really worried. But at this point in time, claims still remain pretty well behaved. But when they start to spike, if and when they do start to spike, that's when you really have to worry about it, because that's going to feed into unemployment. And every time we've had a recession, unemployment has spiked higher.